Parcel shipping costs continue to rise, and consumers are getting tired of packaging waste. What if you could solve both problems at the same time? I'm James Malley, CEO and co-founder at Paccurate. Our packing intelligence platform helps you determine your ideal mix of box sizes and gives you complete control over how they're packed in real time, so you can minimize costs, delight your customers, and ship sustainably. Learn more at paccurate.io.
Anyway, this is FreightWaves, and I'm Anthony Smith here with the one and only Tony Mulvey. And Tony, I don't know if you saw that, but we have a fancy new commercial in the beginning of our show.
You do, and it's impressive. Look at y'all. You and Zach are fancy.
We're doing stuff now, and in regards to that commercial, I have to give a huge shout out to Paccurate. And with no more fighting with spreadsheet, Pack Simulate harnesses the power of Paccurate's patented cartonization algorithm, so you can simulate millions of parcel shipments and identify your ideal carton mix. Learn more at paccurate.io. So Paccurate, huge shout out. Thank you so much for sponsoring us, making the show happen. But Tony, you're here today, and this is the Tony Show, and this is as econ-y as it gets, right? This very Freightonomics, but it's more of a emphasis on the economics aspect of it for today.
Yeah, absolutely. I mean, I think the last time I was on with you, that's what we spent most of the time talking about. So I was going to have you on the spot this morning because I talked about economics. Oh. I mean, it's what my degree's in. Yeah. I remember the college days of studying the basics of econ, and then obviously the more nuanced stuff. Yeah. I got a question for you. What was your favorite econ class?
I loved macro econ, but I did better in micro for some reason.
Interesting.
Yeah. I always like what I'm not good at.
Yeah. Well, that was me. I liked econometrics, right? And that class was...
Yikes.
Yeah. I think the class average was like 48 or something like that, but...
Big curve.
It was
big curve grading.
It was difficult, but it was fun.
It's a fun time. And one of the things I love about economics, it really meshes so well with freight, because when you're thinking about freight, it just comes back down to supply and demand every single time. And we were just talking about Paccurate, and we were just talking about LTL, and kind of leading it off with this news-onomics. One of the big things that we have to talk about is one of the latest stories from our very own Mark Solomon, and he's talking about shippers face new normal and parcel shipment rate increases. And so talking about this, we're looking at some of the key takeaways that there are GRIs, general rate increases, in the new normal. Shippers should be prepared for a shift in the magnitude and structure of GRIs.
Yeah, I mean, you start looking at it and you see FedEx and UPS announce GRIs of 5.9% for 2024. I mean, it's a smaller increase, but it's an increase. And I think that's the key takeaway is, one, UPS followed FedEx's lead here. And two, I mean, you're talking... The pre-pandemic increases were 4.9%. So, I mean, you're up above those. What's interesting is, like, you're in a relatively weak peak season. I mean, even from a parcel shipper perspective, it's going to be relatively weak, just given the macroeconomic headwinds that consumers face. But it sure seems like these GRIs are here to stay. And it's not just parcel that sees these, right? I mean, you see it in LTL companies, right? Old Dominion and your Sayas and the like, they all announce GRIs too. The bigger kicker is who's paying the GRI, right? Because they work with their shipper customers the same way trucking company, like full truckload companies work with their shipper customers, right? They don't pay, no two rates are the same. So while it appears like you're paying these rate increases and you walk in off the street and you're going to pay more. But if you're a large parcel shipper, you're probably you may not be victim to the same increase that everybody else is.
Yeah, and I think one of the big things that you hit on there is who's going to be paying those increases. And really, it always flows downhill to us at some point in time. And so we're looking at increases in prices. And one of the other things that we're going to talk about a little bit later, hint towards it, is going to be, of course, inflation, PPI, CPI. We saw some increases there. So not going to jump into it just yet because we have a few more talking points here. Definitely getting into another one that might start to get into some of those consumer side of things. And that's going to talk to more of air cargo. So we have an article from Eric Coolidge talking about air cargo. We don't talk about air cargo too much on this show, but I think it's pertinent because when I'm thinking about air cargo, I'm thinking a lot of times around consumer goods. I mean, there's a mixed bag, of course, but a lot of times I'm thinking of consumer goods for the most part. And one of the big things in this takeaway is that there could be a saving grace from e-commerce.
Yeah, and I think that's one of the interesting things. I mean, you hit the nail on the head with, in terms of air cargo, it is really consumer goods. I mean, it's your lighter weight consumer goods, but it's also your super high value consumer goods, right? Think iPhones and the like they're not real heavy, and you can fit a lot of them per kilogram or per 1,000 kilograms or 100 kilograms. I mean, it doesn't, so to that aspect, I mean, it's these high value goods moving into very secure areas, right? I mean, there's arguably very few places more secure than an airport. So it's one of those, there's challenges, right? I mean, demand's obviously down, 8 to 10% since spring of 2022. And when demand was booming, one of the issues was, and this is not just air cargo, it's, I mean, everywhere, right? Capacity backlogs grew. The issue is it takes a lot longer to build a plane than it does to build a truck. So and then when you take hold of them, it's like, well, now I have this plane. What do I do with it? It's not like I can go turn it around and it's a lot harder to sell an old plane and take ownership of the new one. There's bigger, more capital intensive investment. I mean, it's hard to say it's investment, but I think that's one of the challenges is that Boeing's starting to forecast some growth, which is a positive if you're a Boeing shareholder, and because that stock has been just beat up in the past few years. Yeah,
and I mean, we're looking at air cargo, like I mentioned earlier, like we talked about, of course, a lot of it's going to be heavily anchored to what's going on with the consumer and looking at their expectations for growth. They're really hanging a lot of their expansion moving forward on the consumer, on e-commerce. And I think that's a big one, especially when we start to look at some of the consumer conditions going on right now. Labor market is holding up for the time being, seemingly. Not the same composition of jobs that we saw throughout the pandemic, but definitely still there. Big on the services, of course. We got to talk about service spending. That's been a huge one, of course. That's not going to feed into some of those air cargo goods demand, but services has been just completely wild, especially throughout the summer. Anecdotal, of course, you look through any of your social media feeds, you're going to see someone at a Taylor Swift concert, at a Drake concert, at a Beyonce concert, at any type of pop music artist concert. They're just traveling. Zach is somewhere gallivanting in Europe, having a good old time, but people are traveling, and I think this is going to persist into some of the winter months. Yeah, absolutely. And I think one of the things to remember, and they're trying to ride the coattails of e-commerce, and you think about what COVID did, it created a pull forward of e-commerce demand, right? I mean, what did it surge to? 60% of spending during the pandemic, and it's since fallen back down, but it seems like there's only so much that can go. You're finding from the consumer perspective is now things have become more available in store and things like that, right? You're not dealing with the shortages, right? You can go to a store and buy what you're looking for same day. How much does that shift because I mean, we've talked about it, right? Retailers and this destocking phase and inventory correction, do they correct to a level where they're trying to push people to e-commerce, or is it? So I think that's going to be an interesting thing that plays out, and it may not play out right now, but over time. The other interesting part is
I mean, majority of air cargo is moved by passenger plane. And we talked about the services spending and travel and things like that. Like, you're oversupplying the market, right? So it's like if you're one of these, just a freighter company, like you're at risk now with oversupply, like the market being oversupplied, right? And it's going to affect rates and it's going to affect demand because it's easier to move demand across when you have the passenger airlines back. So I think it's a very interesting time from the air freight perspective because you took out all this capacity with travel halted. Now it's been added back, but you were also trying to add freighter conversions and things like that during the same period. And now you've done it and your demand's starting to kind of dwindle to some extent. Seems like a recipe for an oversupplied market, kind of like in the truckload space right now.
And that's the interesting thing within the supply chain, within the freight world. We always see these ebbs and flows, but it always seems like there is an oversupply, then undersupply, oversupply, then undersupply in almost every segment of the supply chain overall. One of the big things, of course, that we were talking about yesterday on one of the top stories for FreightWaves Now was with Lori Ann LaRocco, CSNBC correspondent, also a contributor to American Shipper. Is what's going on at the canal and really seeing that there's such a backlog of ships there. And really, folks are still sending their ships, or as Zach would like to say, boats, since he's not here to say it, through the canal instead of, routing all the way around through the Horn and just kind of taking that longer route. But that's kind of telling me that there's a lack of urgency that, hey, we don't have to get this in the warehouse just yet. I mean, what's the rush here? So people are taking that hit, saying, hey, you know what? I'm okay with the backlog. Just get it there.
Yeah, it's and that's the biggest shift really you've seen, right? I mean, that's why people, when you had the backlog in LA, right? People shifted because they could move things into Savannah and Elizabeth and those East Houston. You could move things into those port markets a little easier, right? Eventually the backlogs hit the East Coast. Now, there's no time sensitive. Like, what happens if, a shipment gets there 2 weeks later? Well, that's a week less that it has to spend in a warehouse or something like that. Like, it accelerates maybe the final move once it's here, but it's not like, as long as it's here before, October 15th, you're probably okay.
Yeah.
I mean, like, odds of it making it to the shelf for the retail peak season, even if you want to call it that anymore, because it shifted, right? Yeah. I mean, you look at what Amazon's doing with like Prime big deal days in October, whenever that is, like that's just moving the peak season, it's effectively pulling it forward or lengthening it. Like you may see a surge and then hopefully that it sustains itself from October through December, but it creates this risk of a pull forward, kind of what you've seen on the ocean, right? I mean, it peaked. That freight, the demand levels on the ocean peaked about 3-4 weeks earlier than normal. So I think that there's a risk there that you're pulling. Everybody thinks peak is November, December. Well, maybe now it's going to be October into November. We'll see how it plays out, but
definitely. And I mean, of course, we're also talking about here the drought impacting the Panama Canal, limiting the amount of ships that can make its way through. So that's definitely one to watch. You can check our FreightWaves.com website for that one, of course. But also one of the other big things that we have to talk about here is going to be around the Logistics Managers Index. Of course, Dr. Zach Rogers, we appreciate you, and we're looking forward to getting you back here on the show sooner rather than later. So hopefully you can work out all those IT and tech issues and firewalls. I promise we're not trying to hack you, Zach. You can let your team know. But we're looking at the LMI. One of the big things that we saw was that there was a result of 51.2 percentage points in the overall LMI. That was an increase of 5.8 percentage points. So it went from contraction now to expansion. One of the big ones from that is going to be, of course, inventory costs, which increased 8.6%, now at 69.1. And we also saw an increase in warehouse utilization, now up to 57.8. So definitely a lot of moving parts here. Now seeing that there's expansion in the overall LMI.
Yeah, I mean, that's obviously a positive. You look deeper into it, right? You see transportation prices dwindling or still in contraction. Not a surprise. We've talked about. Now, the rate, I haven't looked at the LMI hand up. But I mean, you start looking at like contract rates from a drive-in perspective, like the rate of decline has slowed, but they're still declining. And then you look at inventory levels, right? You talked about inventory cost increasing, so the cost of that inventory is increasing. I think that's why you're seeing inventory levels contract, right? They're trying to offset the cost increases by reducing the inventory levels, right? We've talked about the inventory levels, I don't know, for months, over a year now, needing to correct themselves, and they have largely, especially at the large retailers, they have the ability to do it with relative ease. Smaller businesses don't have that same ability, right? They're kind of stuck. I don't want to say stuck with the inventory, but it's a more difficult task, right? They can't hide some of these inventory reductions in the form of discounts and things like that. Like their margins are so thin that they can't, like for a Walmart, for example, they've been able to reduce their inventory, but how do they do that, right? They can discount certain things, but they're making margin back on grocery or things like that, right? You're seeing their private label margins expand. And it's like, okay, well, if they take a hit here in, say, electronics, that margin squeezes, but they grow it in grocery and being the world's largest grocery, it doesn't look so bad, right? They can mask these inventory gluts that they had and reduce them to a way by discounting, but they're making it up on a different, whereas a smaller business doesn't have that same luxury.
Yeah, and I think it's interesting. We're looking at, of course, one of the big things that Dr. Zach Rogers and team highlighted here is that a lot of the growth is being spearheaded by larger firms. So that growth is definitely starting to happen with investments in inventory and warehousing, contrasting the slight report from the previous month. But we're seeing that in both upstream and downstream firms. And one of the big things that I kind of am looking for moving into more of these holiday seasons, I feel like it was just almost like it's been a holiday season. Now we're about to go into another holiday season.
Yeah.
I don't know. This year is just flying by. I don't know about all you guys, but it's been flying by for me. But we're looking at one of the big things for the consumers. As you know, we never bet against the American consumer. No. They're going to spend until they're on that last dime. And so one of the big things that I'm expecting is before consumers just shut it down altogether, and this is why I was a little bit suspect of that seeming evening out in the most recent or the previous credit card utilization report that was released that showed some sideways or slightly downward movement for revolving credit, was that consumers will likely trade down in goods before they stop spending overall. Even if we're seeing, of course, student loans right around the corner, we're seeing, of course, I think a big one that not a lot of people are talking about are going to be car payments, car notes, that I think are going to definitely be a meaningful talking point in the coming months here, especially as we get to the holiday season. Folks are going to definitely start to say, hey, you know what, I got to get out of this car before I get out of this house. So I'm not so much concentrating on homes or mortgages just yet, but I think cars are going to be a big one to watch. I think consumers are going to start trading down in the goods before they stop goods altogether. And I think there's going to definitely be a bigger portion put on services than what we've seen probably in years before. Yeah,
I think so. And I think one of the interesting things is, I mean, I looked at Bank of America. They released a survey studying consumer debt. And it was like more people had missed a credit card payment or had missed a credit card payment in the last 6 months than didn't miss any payment across any loan. I think that's interesting. And I'm looking, I've got a chart here that I got it off Twitter from a car dealership guy, which incredible follow, by the way.
Sounds legit.
But it was talking about, well, this comes from Equifax and Moody's, and it was talking about delinquencies by type of debt. And you see consumer loans up over 5%, credit cards up almost 4%. Auto loans up at almost 4%. They're at like decade highs, all of them. And I think that is a concern, is that we're at these delinquencies are rising at a rate that is borderline terrifying, because it resembles what it looked like going into 2008. And granted, we're not at the levels, but the upward move. Then you factor in what happens when these student loan payments come back. I mean, I got the email this morning about, from my perspective, of like what mine's going to cost me each month. And does it affect, how does it affect each consumer by themselves, right? We can talk about the actual impacts, right? Of what is it, estimated like 14 billion a month in terms of taking that out of the economy. It's not a huge percentage when you look at retail sales, but I think it's, what does that do to the psychiatric side of it? Oh, hey, this bill's coming back. Like, we got to tighten even more than what we thought. Until, like, it's like this, let's see how it plays out, and then we can come back to spending. I think that's what you're going to see, is maybe the initial impacts are greater than what they maybe should be, but then it works its way back to equilibrium. Because that's kind of how it happened with COVID, right? If you go look at like the personal savings rate, obviously stimulus impacted, but there was just an initial surge. And that's why you saw freight demand drop like off a cliff, is because people didn't know what to come. Like, the psychiatric side of it came out. Like, they were thinking, oh, everything's ending. Like, we need to save as much money. Like, the world is ending. And then it worked its way back out to the spending boom. I'm wondering if this doesn't have a similar impact. Not similar as in terms of the same magnitude, but an impact like that, where the initial impact is greater than what it actually turns out to be in the long run.
Yeah, and I think when we're looking at the state of the consumer, and really, I think the overall macroeconomy, including the Fed, they are up for an interesting time, because this is going to be one of the scenarios that we were talking about months ago, where, okay, inflation not below or anywhere near 2% just yet. Starting to see it actually increase, especially with the aid of energy prices and gas. We can kind of talk to it a little bit right now. CPI up 0.6% in the latest month, up 3.7% over the last 12 months, with an overall increase of 5.6% in energy. I know that's a lot of percentages, but big one here that you got to think about is going to be the gain of 10.6% in gasoline. And of course, shelter up 7.3% year over year. So these are going to be some of the more volatile, of course, segments, but segments that are definitely necessary for a lot of Americans, especially going into some of the winter months where we're going to need energy to be utilized for heating a lot of the different areas.
Yeah, that's typically where you see the energy prices increase, or into the winter months. I think the big call outs, the 0.6 month over month is the largest increase at any month over the last 12 months. So over the last year, this is the largest increase month over month. And then the other one, core, right? Remove that food, remove the energy. It's up 4.3% year over year. That is what the Fed is looking for to get to 2%.
Yeah.
And that seems, one, like a pipe dream, because everything continues to rise, but it also fuels their fire, or adds fuel to their fire of raising interest rates.
I see what you did there.
Yeah.
I see what you did there, Tony. Adding fuel to the fire, gasoline, fuel price. That's good.
But, I mean, that's, it feels like it's set up for another rate increase, which is a demand destructor, and we've already raised them so high and so fast that it hasn't actually been felt, I don't think. I think you're still starting to see or feel the impacts of higher interest rates. And if they go and raise them again, it's like, how far are we going to go? Because it feels like you're going to start really squeezing the consumer, and that in a time where they're going to get squeezed in other ways, and you really want to kill the economy, it feels like it would be overkill.
Yeah, and I think one of the big thing that is kind of counterintuitive to some extent is going to be some of the deficit spending that's going on. It's kind of like, talking out of both sides of the mouth from the U.S. standpoint. And so also we saw the PPI also increase, large gain from energy. No surprise there. Retail sales up as well, 0.6% in the latest month, with a drum roll here, 5.2% increase in gasoline prices. So that's another big driver there. So a lot of energy increases throughout the entire segment.
Yeah, I mean, you think about that 5.2% increase at gas stations, and you're talking 10.6% increase in prices. So real spending negative month over month. I mean, what if it was 1-to-1, it's a 5% drop?
Yeah, and it gets tricky, but retail sales not even adjusted for inflation.
Yeah, and you're up 0.6. So, I mean, effectively flat. And it's just, some of that's not a surprise, right? I mean, you would have expected, I think it's interesting that it's up, because I would have expected to be maybe lower month over month, given what you saw in July with retail holidays and the like. But when it's being driven by gasoline, it's easy to offset any risk, I guess, associated with those holidays.
Yeah, and in closing here, as we gotta also thank everyone that made this happen. Also thank Cubiscan, where we provide weighing and integrated systems that increase efficiency and profitability. A WMS, ERP, TMS, or IMS is only as good as the data that powers it. You don't need that bad data, so definitely get yourself some good data, and we will help you collect accurate product, parcel, and pallet data that you can use to power the software systems within your warehouses, distribution centers, and cross-dock. So Cubiscan, thanks so much as well for making this show happen. And all of you, thank you as well for watching. Thanks so much, Tony, for jumping in here as Zach just kind of runs and scurries throughout Europe doing who knows what, just having a good old time supporting the European economy and not the U.S. one. He could be doing this in Texas.
Yeah, it could be better in Texas.
It could be better. I hope he's just drinking more.